So as I said when I gave my introduction, I've been working quite closely with Hanul on our sources of finance work. So we thought this would be a good forum to introduce some of the insights that we can draw from the model which we created. I'm going to present a lot of information on this slide. I'm going to go through it quickly, and on the subsequent slide, I'll dive into some of the key findings for emerging market and developing economies. So bear with me. But in short, our sources of finance model covers who is providing the finance today, or over the past 10 years, into the energy system, broken apart between commercial financiers, domestic public financiers, as well as international public financiers. We track who exactly is making the investment, whether those be private corporations, state-owned enterprises, or households. We also track the instruments that are used, including debt, equity, and grants. And important for this slide, we also measure where this finance is going to, both in terms of destination by sector, as well as by region. And really, the key thing that I wanted to point out now is that in 2015, total energy finance going to emerging market and developing economies, that was 35% of the global total in 2015. A lot has changed over the past 10 years, both in terms of the financiers, the sponsors. Bear with me, I'll get into the details in just a second. The instruments, but really the key thing is that in 2024, what we see is that investment into emerging market and developing regions, or as a share of global, has declined from 35% to 27% in 2024. And as we said before, if we look specifically at their share of clean energy, it's actually even smaller at about 18% today. So on this slide, I'll go into the details of the energy finance landscape in emerging market and developing economies. So what I'm showing on this slide first is total energy finance. So this is all EMDEs excluding China. So if we look at the debt to equity split between 2015 and 2024, on the surface, there doesn't appear to be too much change, but you can see here at the absolute level, we have seen a decline in overall finance. When we look at who is providing the finance, two things to point out. The first is that actually we've seen a decline in commercial finance that has been made up partially by an increase in public domestic finance. And so that would be subsidies, other tax credits or incentives, as well as government ownership, equity ownership into private or state-owned enterprises. Just very briefly, when it comes to public international finance, my colleague Hanul will really dive into the details of this. But if we look at total energy finance, we've actually seen a decrease in public international finance going towards EMDEs. From 2015 to 2014. And then finally, in terms of who is making the investments, we've seen corporate investment remain about constant. Investment by state-owned enterprises has actually come down since 2015. And a very interesting development, I think, is the emergence of households as a major driver of energy investment today, where household investment has increased significantly over the past 10 years. But I think this really becomes a lot clearer once we look at clean energy finance in particular. For the debt to equity split, we can see that for clean energy finance, debt really is king. Access to affordable debt is really essential for clean energy, given it is highly capital intensive, right? And so actually, when you look at the instrument breakdown for clean energy finance, what we're going to see over time as the world begins to invest more in clean energy is probably an increase in the use of debt. Fossil fuel financing relies a lot more heavily on equity, and so we're expecting the debt share to creep up over time. In terms of the financiers, when we look at clean energy finance, we see actually the complete opposite to what we've seen if we're looking just at total energy finance. So in particular, commercial finance has increased significantly for clean energy. There's a lot more private enterprises involved in financing clean energy than total energy. And so what this actually implies is that when we're looking at total energy finance, that decline that we've seen there is actually a reduction in commercial finance going towards fossil fuels. For clean energy, much more commercial finance, and indeed, actually an increasing amount of international public finance is going towards clean energy. I think this shows it perhaps the same message, much more clear, but in terms of who's making the investments, corporates are really driving the increase in investments into clean energy. But as I said before, households have emerged as a key driver, and really that entire growth that you've seen on the left-hand side of the slide in household investment, that is being driven by clean energy. This is the Pakistan story, which I mentioned. Solar home systems have really driven most of the investment historically, but increasingly we're seeing much more investment in batteries in emerging market and developing economies, as well as electric vehicles. So that's just to provide a bit of a high over of how the situation has changed over the past 10 years in emerging market and developing economies. And I'll hand over to my colleague, Hanul.
I'm just keen to understand why an overall reduction in energy investment in emerging markets. I see that clean energy, there's a significant drive towards that. But I think my confusion is that there's still a significant supply gap, particularly looking at sub-Saharan Africa. And there, you would probably require a mix of energy technologies to fulfill that supply gap. And certainly, I don't think it will only come from clean energy. And I'm just wondering, is it because you know, the financiers themselves are more geared towards financing clean energy rather than you know, gas to power, for instance, which is viewed as a transition fuel. Just keen to understand that, because there's really a significant supply gap in sub-Saharan Africa. Thanks.
In terms of what we're seeing, and I'm going to speak more generally for developing countries and financing of fossil fuels around the world than to sub-Saharan Africa, because I'm not as close to that region. But what we are seeing in our conversations with a lot of the international and the big commercial banks is that because many of them have net zero targets, they're very hesitant to be financing fossil fuels, especially those who have maintained their commitments there. You've noticed probably that a lot have been pulling out from different aggregations, but we've seen, with the exception of perhaps a couple in the United States, most large international commercial banks are maintaining their net zero commitments, which means that when they are evaluating requests for lending to large international oil and gas projects, they're evaluating that against those commitments. And unless you have reasonably short-lived projects, this is US tight oil, then the funding of exploration in long-term oil and gas exploration becomes a question of whether this aligns with their net zero scenarios or not. I think gas as a transition fuel is something that we get a lot of questions to, that it's very difficult for the IA to say, yes, this investment in gas aligns or it doesn't. Where we do see continued support for funding is in a couple of things. Where you have domestic commercial banks and other lenders, we still see a lot of capital going to fossil fuel investments, but this is particularly in the Middle East and in parts of Asia. The Middle East, because you still have very low-cost resources that can be developed, and what, at least in 2025, is keeping some investors from financing projects is the news. There were articles about a month ago that were calling for peak oil in China. This is not us as the IEA saying this, because it's too early to know if oil demand in China has peaked or not. But what we're seeing is that the very fast rollout of electric vehicles is leading and will lead to peak oil development in China. Whether it's this year or next year, we have to wait to see what the data is showing us. But as we all know, is that once China peaks in its oil demand, the rest of the world will also peak soon after that, because these drivers of e-mobility is really going to have, and we've seen enormous impacts in oil demand. In the case of gas, which I think was your question, we still see gas as being a significant transition fuel, but it really depends on the markets that we're talking about and your price expectations for natural gas. Our view is that in markets that do not have adequate resources of domestic gas, this is the case for, let's say, Southeast Asia, there is a lot of concerns around import supply dependence and volatility in gas prices, what that will imply in your overall cost of power. So we've seen many markets, especially those that can benefit from this, I think, this very sharp reduction, not only in the price of solar, but also in the price of batteries. So you have a nice mix of solar plus batteries becoming increasingly competitive. And what is really driving these or keeping these technologies from hitting parity is financing costs. So if we can reduce the cost of capital for solar and batteries, and we have seen that happening in many parts of the developing world, we can also help to drive down clean energy costs, making it increasingly more competitive. And as James mentioned, the case of Pakistan, where you have a situation of high utility prices, you have consumers, large consumers, who are driving that shift without any real source of subsidies. So there are an increasing number of markets where this makes sense to go for more renewables than investing in gas-fired generation, because people are worried around what the risks of stranded assets are going to be. But gas will play an important role in helping to integrate and as a firm peaking source in periods of very high electricity demand.
One question on your previous slide, James, so that we could reconcile all the data with the next session. Will it be right to say that the access to debt and equity is clearly not equal, depending on the type of customers? I would assume that to have a kind of average of 50-50, you are blending residential with corporates, and this is possibly one of the challenges today, which is to get residential to also access debt. But we will see later that luckily IPPs or corporate do access renewable energy debt, and the ratio will be different. And if you could just tell us what will be, first, what is your assumption when you come up with this 50-50, and what will be your views on access to debt for renewable energy financing?
Yep. So just to be clear, so this clean energy finance, this includes both renewables, but also includes electrification of end use. It includes many different sectors, not just renewables. But you're absolutely right that what we include in this is, and as I pointed out, household investment in solar systems in emerging market and developing economies makes up a big share of renewable investment. And that is mainly today financed with equity, not with debt. If you're looking specifically at utility scale renewable energy projects, there the debt to equity split is completely different, and it's majority financed with debt. We actually wrote about this in World Energy Investment 2025. We saw some quite interesting and encouraging trends in emerging market and developing economies in 2024, where that debt share was increasing quite a lot, actually. And so we think that this is in response to more favorable macroeconomic conditions trickling down. But really, we would expect that debt share to increase in emerging market and developing economies. Access to affordable debt is absolutely key. Yeah.
this graph, we can be careful about the fact that on the right we have $1,000 billion, and on the right we have only 400. So
Yeah.
we get the impression that we have the same size, but in fact it's only half of it. But my question is about how the structure, how it is financed. For example, if we compare from developing countries and developed countries, and we can see here that the most of the cost is supported by, in fact, by the states and the public, instead of in developed countries is mainly by households and corporates. And also the fact that we have an increase of the debt on 2014 compared to what we have on the 15 is not that good news. In fact, it means that we don't have the availability of equity that is necessary to finance those kind of investment. Maybe you can first word about, in fact, the difference, the difficulty that we have in developing countries because of the small parts of the private corporates and households supporting the cost, when it is the case in Europe, for example, when you have electrical vehicles, buildings, and the final price of the increase of the electricity, for example, is paid by households and not that much by public, while in developing countries, much are supported by public institutions because the availability of funds on the resources on household and corporates is more limited.
Yes, well, I think you began to answer your question. I think a lot of the clean energy investment today is happening in the power sector. So we're talking about investment in renewables here. We're also talking about investment into grids, which is a major component as well. And that will make up the majority of investment. And I think when we look at power systems in emerging market and developing economies, we often see that the utilities, the TSOs and the DSOs are sort of vertically integrated, right? So SOEs play a major role in financing clean energy in emerging market and developing economies, much more so than what we see in developed economies where there's a lot more competition introduced into power systems and how they operate. And so that's really a big reason why we see that divergence, right? You're absolutely right that in advanced economies, we see corporate spending making up a much higher percentage of that bottom chart there, right? The SOE shares is much lower.
Today I'm going to talk to you a little bit about the purple section that you see right here, the very small purple that you see, public international, or international public finance that we call it. So we've been tracking the role of international public finance, or specifically development finance institutions, since our last WEI. And a couple of caveats here. The IEA are part of the OECD organization. So a lot of the data that we do and the work that we do is in cooperation with the Development Assistance Committee and the DAC, also other OECD member institutions. So our main data source being the DAC, we understand is different from the membership that we have here. So when we say these headline numbers, please bear in mind that there are certain differences. But the whole gist is that despite the international public finance being very small, and by small we mean about 7% of EMDE's clean financing other than China, there's still a very big important role to be played, as Cecilia mentioned, mainly because of several reasons, but a lot of this falls down to the risk that is perceived about having especially clean energy projects in EMDE. So in our cost of capital observatory, and also we have a report on reducing the cost of capital in emerging markets and developing economies, we have found that in 2022, the financing cost for solar PV, for instance, can be up to 2 times higher in EMD compared to advanced economies. And this is a problem because while in Europe or the United States, financing costs is around maximum 40% in these kind of projects. Whereas in EMD, you can see this number go up to 60%. This means that there's less availability for capital to go into other operating expenses or other fixed costs that you would see in any types of renewable energy projects as well as clean energy projects. So this is where we believe that international public finance plays a huge role, not just in the headline numbers that we see, but in the role that it plays of encouraging other financiers to come in. First, as reliable capital, but also as to building trust in these interactions. So we're just going to walk you through the different types of international public financiers that we see. Here's a breakdown of the categories that we split it into. The largest green that you can see is development finance institutions. And by DFIs, we follow the definition that has been set by AFD a couple of years ago when they were mapping out around 500 public development banks and MDBs. And so this is the definition that we abide to. So it's a could be a little different. We also look at Chinese development finance institutions. Multilateral climate funds is an addition that we put in last year. And so we track 4 different funds: the Adaptation Fund, Green Climate Fund, the GEF, and also, I'm missing out on one. I will get back to the last one. And then the other group that we have worked about a year with is the export credit agencies at the OECD. So we work with the export credit group. We've received their data for the first time, and we have data up to 2023 about their transactions. And so we've been focusing on where their transactions are going into EMDE. So I'm going to walk you through what we see, the different roles they play, how much is being financed, and so on and so forth. This is the type of metrics that we look at when we look at international public finance. So quite similar to what we look at the sources of finance that James has presented, but a bit more focused on what is the source, also what instruments there are. So here you can see debt, grant, equity, and also there are some guarantees that are being reported to the DAC, unfortunately less than 1%. So we see this as a very big problem. Either it's a reporting issue, or we see it that there needs to be more guarantees put in there, but a bit more on that later. Also, we look at the type of financing that's offered. Since we abide by the DAC definition, we look at the official development assistance and other official flows. But also, we do understand that even if it's not up to the ODA standards, there is a level of concessionality in the financing that is provided by these international public financiers. Another thing is technology. So you can see that clean energy is the majority, and there's still some fossil fuels going on here. As Cecilia mentioned, there is some gas. Also, since this is a 22 to 24 average, there has been a little bit of coal projects that were included in this data set. But you can see that as the time goes, that the share of fossil fuels has definitely decreased compared to what it was in 2015. And then as for the regions, it's the different regional categories that you see for emerging markets and developing economies. And if we look at the past, the most recent 2 years, we don't include 2025 for DFIs since our last available information is not as recent. But you can see that international public finance delivers around $32 billion a year for energy. And over 70% of this goes into clean energy projects. And this is a very prominent number that will support more interactions going into international, into global energy finance and clean energy in particular. So going into the different categories, so DFIs being the largest providers of international public finance. So you can see here, you can see the spending of different DFIs, DFIs outside of China and Chinese DFIs. Here we include China Development Bank and also China Exim. So these are the 2 institutions that are being represented on the right. You can see that over time there has been a very big change in trends. So as for development finance institutions outside of China, there has been an increase in financing over the past decade, although there has been a little dip in 2024 and possibly a further dip in 2025 if you've seen recent trends about ODA financing. The DAC has recently put out a report that they expect about a 7 to a 19% decrease in the ODA commitments up to 2027. So this definitely will have an impact on energy financing as well. But as you can see, the biggest bulk of financing today is grid and storage, as well as solar and wind, and other renewables is also featured in here. But you can see that renewables and grid and storage has been the most prominent category in the type of financing that is done by development finance institutions outside of China. As for China, you can see that the flow is pretty much petering off after 2023. This has 2 issues. One is an issue of reporting. So the public information that is available regarding Chinese DFIs, the most recent being 2022 and 2023, they have shown a very significant decrease between these 2 institutions that we track. Annually, they're doing less than 6 billion, which is a significant decrease from what it was before. But a very good sign is that in the number of projects that are being done, there are no longer coal projects as that was committed by Xi Jinping in 2021. And in the commitments that they have recently through their sovereign wealth funds, which we cannot capture the data, but we know that there are projects being funded, they are being more strategized towards clean energy and to smaller projects. So you can see that there has been a change in trends. But so these are the main categories that you can see with developed finance institutions, and they definitely play the biggest role when it comes to the international public finance landscape. Yes.
Thank you. Do you put large hydro into storage, or where is it?
Sorry, I see that low emissions power is not included here. So other than solar and wind, there's another category that I somehow did not include it, but I will update it. So there's low emissions power, so including hydro and other renewables, as well as, well, although nuclear is not very prominent in the development finance landscape right now, the World Bank has recently said that they will start, they have an MOU with IAEA starting June. So there is certain levels of low emissions power in there. So that would be an additional about 5 billion in this picture, depending on which year you're looking at. Yeah, apologies. Thank you for pointing that out. The next thing is multilateral climate funds. This is definitely a smaller group than you can think of because of, as you can see, the scale is in the millions here. So you can see an average about a bit over 1 billion that is being put by these 4 different multilateral climate funds from 2015 to 2024. But if you look at the role that they play, it's very significant because over 90% of their financing, well, close to, we can almost say 100%, is going towards clean energy. And this is prominent because they are playing a very important role in kickstarting a lot of projects in EMDE especially. And you can see that especially the role of for example, the Green Climate Fund, a lot of MDBs and other DFIs are trying to accredit it by the GCF in order to have more projects within EMDE. So they play a very significant role other than the direct financing that they provide. And you can see that here also technology-wise, the most of the financing is going towards power. And there has been a shift to end-use sectors. By end-use, we mean buildings, transport, and industry. So you can see that there has been a shift in the type of financing that they're providing, since a lot of providers are, even commercial providers, are going towards power projects such as solar and wind. A lot of focus is currently needed towards end-use technologies. And this is a very big role and niche in some ways that the multilateral climate funds are playing in this international public finance landscape. And the next group is just going to delve a little bit into export credit agencies. So this is a new addition to our World Energy Investment Analysis this year. And we think that this is a very important institution, mainly because of that figure that I showed you in the very beginning of the 5 bars, where we see almost no guarantees. And although this might be a reporting issue, this is also in conversations with a lot of DFIs that we had, that there is very little that is actually going into directly de-risking projects rather than, or debt financing or grants. So, but export credit agencies really fill this niche, this gap that we see in a lot of development finance institutions by providing this much needed guarantees that are needed to really push through clean energy financing and emerging market and developing economies. And so if you see that the one in the solid colors, these include an element of guarantees or a credit cover, so to speak. So 84% of this officially supported export credits that are provided by OECD reporting ECAs, you can see that they are provided in the form of guarantees. So this not only, this means that they are really encouraging the private players, the commercial players that we would really need to be entering these transactions to make a lot of investments into these projects in EMDE. And so they do not only direct credit, but here you can see the blue, the pure cover, that is the credit risk cover, the guarantees that you see. So they are playing quite a prominent role in a lot of EMDE. Actually, more than half, about 80% of their financing is going towards emerging market and developing economies, which is very prominent to see. And you can see a demand that there is a demand for guarantees and also this credit risk support for a lot of these commercial actors that are within these countries. So we see this as a very important point to note when it comes to clean energy financing in EMDE. Sorry, excuse me? Oh, my apologies, that's billions USD, yes.
One question here,
Yeah.
because I think 90% of the PV panels are coming from China, 60% of the hydro equipment, on I think 70 of the wind turbines. So obviously, speaking about ECAs, as far as we are concerned, it's like the Chinese ECAs. And could you tell us what is approach now in the future with regard to coverage on the ECA support?
In this figure, you won't see any Chinese ECAs. Sino-Shore is
exactly.
a
That's why I was asking, because since 90% of the equipment are coming from China in renewable, it makes this chart not confusing, but not that relevant for our industry. basically ECA will have to come from China for a PV panel.
Although it's true that China really plays a significant role in this in clean energy supply chains, if you see here, well, we haven't split out the members for privacy reasons, but there is a lot of agencies such as the Danish Export Credit Agency that is very prominent in wind financing. There's quite a few ECAs within Europe that is specifically focused on clean energy financing, and they're very interested in motivating the businesses within their countries to go into EMDE to promote these clean energy financing. So although it does not include the big chunk of China that you see here, it is still prominent to see that there are institutions
can finance projects that don't necessarily have a majority equipment from their manufacturer. They just have to have significant national benefits, and how that's defined is extremely broad. So it doesn't mean that, for example, a German ECA can only finance projects that is 100% equipped by German manufacturers. If a German developer, if there's significant engineering involved, which is very much what the Germans are very strong for, they can actually still participate in a project without necessarily being tied to the manufacturing side of things. And we see this actually happening more and more because of this desire to support more private capital mobilization. And this is where ECAs are really the strongest, is this ability to bring in the private sector because they can provide the coverage that's needed for commercial banks to come in a deal.
So they really do play this enabling role when it comes to transactions, but something that we need to note is that a lot of the coverage that is going into EMDE is still focused into fossil fuel projects. This is not just the willingness of the export credit agencies that are providing the support, but it also has to do with the demand of the countries that are receiving the support. But if you see here, you can see that there is still a niche, a needed guarantees or this kind of credit coverage that is very important for clean energy in emerging markets and developing economies, and that is still not being provided. And I want to leave you with this one last slide. Since the focus of this workshop really has to do with private capital mobilization using the sources of public sources that we have. So this is a calculation of the private capital mobilization of energy-related sectors that we see, at least in the DAC. So we did this calculation 2 years ago, and at that point, the average that we see for every dollar that is being spent in different for energy was around 30 cents that was being mobilized. So, but in this new figure, we have data up to 2023 that was updated recently by the OECD based on their private capital mobilization numbers, and we did a quick calculation of what it looks like today. So if you look at the energy-related sectors, you can see there's energy, transport and storage, industry, construction, and mining. And to note, this is not all clean energy. So if you look at disbursements, that's around less than 50 billion before 2023. Now it has exceeded 60 billion now. You can see that this is the amount that is being mobilized through the disbursement of the different public finance institutions that are being reported to the DAC. So you can see that energy, transport, and storage is still a little lacking, whereas industry, construction, and mining is actually having more, is creating more financing per dollar. So for every dollar that is being dispersed by this international public financiers outside of China, less than 60 cents are being mobilized for energy-related sectors. And if you take out industry, construction, and mining, that number becomes a bit over 30 cents. So that's a little bit of an increase compared to the last number that we had, but still there needs to be a lot more done in terms of private capital mobilization. If you look at by income group, you can see that there's the least developed countries that actually needs the most financing is still the weakest and when it comes to private capital mobilization. Also proof that there needs to be more direct financing that is going towards these countries. But also you can see that for least developing countries, they mobilize less than 30 cents of capital for every dollar that is being dispersed, which shows that there needs to be more enabling environments for public capital, for private capital, as well as more strategic allocations of different concessional financing. So the last slide I leave with you today is something that Cecilia has mentioned, that we worked with the G20 presidency in Brazil to map out where we should be directing our very much limited but important concessional finance and public finance needs. And this is part of our G20 roadmap. So you can see in the left, this is what is currently going being financed by international public financiers to clean energy. So you can see that there's a very prominent role that that these financiers playing, especially in solar and wind. Also, there's a very big chunk that is going to grid and storage currently. And as you can see, as you might expect, a lot of this financing is currently being directed to Africa, India, and Latin America. But in 2035, if we look at what is actually needed to meet this 1.5 scenario in 2035 and the concessional funding that is needed in this time, you can see that there needs to be a lot more that is being directed into grid and storage, although this is already a prominent chunk. Also, there has to be changes in the types of technology that is financing, since a lot of these power projects is garnering interest from commercial actors. Although still it is prominent, more concessional financing needs to be targeted towards technologies that are more nascent or hard to abate industry and transport sectors. So you can see that the dark purple on the left, although being a very small sliver, is growing significantly to the second biggest sector. So that would be a lot of these buildings, industry, the end use sectors that are extremely important when we see the concessional financing targets for 2035. So these are the messages that we have prepared for you today, and thank you for your attention. Yes.
On the last slide, I wonder if you have any findings on the funding for transition finance. Like for instance, it's nowadays in some countries, I believe in South Africa, maybe in Indonesia as well, especially in Indonesia, we have faced some funding I won't say challenges in terms of transitioning the coal-fired power plant to the clean energies. But as you mentioned, Cecilia, on the funding itself, many commercial banks, they hesitate to finance that because it's related to coal, while we need to transition the coal power plants to clean energy, which costs a lot. And the technology itself is not cheap, so where is it, the funding? So yeah, that's my question on this. Thank you.
Thanks very much for that very good question. And it's clear that to help coal-dependent countries transition away from coal-fired capacity towards low-emissions fuels, they're also going to be, we'll also need to support them in that transition. The IEA is undertaking a number of projects that are working with different stakeholders on how we can finance that transition away from coal through the use perhaps of transition credits, the international community through the JETP, as well as the ADB are looking at different coal transition mechanisms. It's clear in our conversations with the private sector, while there's a lot of interest in transition credits, their ability to finance the retirement of coal is quite challenging because of their commitments. And there needs to be more work to clarify some of the transition finance taxonomies and definitions of what can be enabled by different jurisdictions. And a lot of this work is still ongoing. The green finance portions are a lot more straightforward. Most financial institutions are very comfortable and happy to finance solar, wind, provided that the cash flows are strong enough to cover the financing costs of those projects. But in terms of coal finance, this is something that the financial regulators and the international community will need to be supporting on as well. Thanks.
I just wanted to come back to the question around technologies. Where does, for example, green hydrogen? I know it's very minuscule at the moment, but in terms of the role of vertical funds, your climate funds, you mentioned that there would be a reluctance, let's say, for them to get involved in solar PV as those technologies are now more advanced. So you're seeing more commercial funders, so there wouldn't be a very strong additionality argument. But for other clean technologies, there might be, more risk associated with, those. So where does green hydrogen fit into this? Even though it's quite a small contribution at the moment, I guess.
So that would go into the orange that you see in low emission fuels and CCUS. We didn't model separately green hydrogen per se, but in the G20 roadmap, we have mapped out the different types of financing that is needed. So one for nascent technologies and one depending on country risks. So the more nascent the technology is, the more risks that is being perceived within that technology which really brings the need of concessional financing needing to be targeted towards that. So that the orange there would be a perfect example of what would be nascent and what would really require the role of public finance to really kickstart the investments in those risk-associated sectors.